Well, thank you very much, Mathieu. Thank you for putting on this event, and thank you everyone for coming out tonight. It seems like a good crowd, so very happy to be here and to be presenting Canadian cannabis. First off, before we get started, just a little bit about myself, so you know who's presenting right now. My name is Andrew Semple. I joined Ventum Financial in January 2018, so I have been here for the full ride in Canadian cannabis. I became head research analyst myself in March of 2020. My initial thesis had largely been around US cannabis names and Canadian cannabis retailers. Those two themes had significantly outperformed and was one of the reasons that our top picks have delivered a total gain of 137% since I have been research analyst against an average loss of about 60%. For the main passive benchmark we have been using. In my opinion, what's even more important than the absolute returns have actually been 18 out of 20 quarters we have outperformed. So this wasn't one or two speculative bets that paid off in the cannabis industry. This has been consistently looking for outperformance and value ideas for our clients. One of the more recent themes we have gravitated towards and been very vocal about is the opportunity in Canadian cannabis, which we brought to the table in January of 2024. So why do we like Canadian cannabis? First off, just taking a big step back and looking at where we are in the capital cycle. I am a value investor by training. I do believe in the capital cycle. When we look at this industry, equity capital has largely not been available for most of these companies for the past 4 years. Many participants are exiting the industry. Production is being taken offline by most companies, and we're also seeing ongoing industry consolidation. Number two, I think we're beginning to see who the clear winners are. This is no longer guesswork. I think there's clear evidence of who's emerging as leaders in the Canadian cannabis market. Point number three, I think we're seeing early signs of barriers to entry being formed in this industry. One example that I provide on the slide here is on the provincial distributors. Initially, provincial distributors had a mandate to list as many products as they could on store shelves. That is no longer the case. These companies want to work with reputable suppliers that provide products that turn on store shelves, that have brand loyalty, and that provide shipments on time and in full. They don't want to be shortchanged on their shipments. So only the good operators and the cream of the crop are really rising to the top. If I were to summarize point 2 and point 3, I would summarize those as being the industry is getting de-risked. We have better visibility. We have more confidence in the Canadian cannabis companies that we believe are the winners. In addition, I think the valuations for these names are compelling. I've got a slide on that, so I'll touch on that in a bit. And again, I've got a few slides on the catalyst in this space, so I will touch on that a bit later. So first off, coming to point 1, the capital cycle and where we stand. Again, well, very hard to see on the screen here. On the left-hand side, there was supposed to be a graph that showed the HMMJ ETF. Since I've become analyst in the sector, what you would have seen is a graph that was a little bit bumpy, but collapsed, and collapsed from the top left to the bottom right. It's been down in essentially a straight line. In total, since I've been a research analyst, the Canadian cannabis ETF is down 92% on average for an industry. There's been total capital evisceration for many Canadian LPs. What this is prompting is it is dissuading new entrants. We're not seeing new entrants come to the Canadian cannabis market. So we're not seeing new players, new supply being added. We're still seeing industry consolidation. The second point I'd like to make is just on the valuations and where we stand today. I would say the valuations today for the Canadian industry broadly is now being based on reasonable economic realities. If we were to take a snapshot on where valuations initially stood for these businesses in January 2019, the sector, the largest Canadian companies traded at an average sales multiple of 30 times and an average next 12-month EBITDA multiple of 209 times. And of course, those companies would widely miss their expectations. If we look at where those same companies or a very similar group of companies are today, those very similar group of companies trade at 0.6 times sales and 7.8 times EBITDA. So again, much more reasonable valuations grounded in economic reality. And we think within this group, some of the top quality operators are trading at an outright attractive valuation. And we'll get to those names in a second. Well, given the complete capital evisceration we see in the space, the first thing I hear when I say Canadian cannabis is the sector is broken, it's not worked, the government messed up, nothing's going right. But when we look at the actual Canadian cannabis sales, that's not what we see. We see an industry that's budding, that's been growing consistently, and that's become quite sizable. On the graph on the bottom left is the retail cannabis sales as reported by Statistics Canada. What you'll notice is that that's been growing steadily and pretty consistently and has reached 5.4 billion over the trailing 12-month period, larger than the craft beer market here in Canada. So this is a sizable industry. On the graph on the bottom right, you'll see the year-on-year growth rate for retail cannabis sales. Again, mostly positive, and it's been in double-digit territory for most of its history. More recently, in the last 18 months, it has slowed down a bit. We've seen a resurgence of illicit market activity in Ontario. We've seen ongoing price compression, and we've seen industry exits. That said, many of these headwinds may prove to be temporary. I think we're already beginning to see pricing stabilize, if not even turn higher. We are seeing better enforcement of the illicit market, and provinces are still incentivized to bring as much demand into the legal market channel as they possibly can. So, I would pose to you, if those headwinds turned into tailwinds, we could see growth pick up here again. I would also point out that it's hard to make out here, but in the last reading, trailing 12-month sales are up 2.7% year on year. If we are still seeing price declines in the high single digits or low double digits, that would imply that volume growth is still in the low double digits. So this is still an industry that is in a structural growth. Usage rates, I believe, are growing at a reasonable rate. And as we start to see prices begin to stabilize, I think that will become more evident in the financial results. Okay, so fine, the industry is growing. We can accept that. Then why haven't the companies that we're all familiar with, why haven't they grown? Why haven't they done well? I would argue that you're looking at the wrong companies. So on the screen here, I have a chart of what were the 3 largest businesses as of January 2019, and I summed up their total cannabis sales and total EBITDA. That is the chart on the left-hand side. What you'll notice about that chart is even though I show that Canadian retail cannabis sales are up 5-fold over the last 6 years, these companies have not materially grown their net cannabis revenues in 6 years. These 3 companies are, of course, Canopy, Aurora, Tilray. There are others that could have made that list from the early days of the Canadian market. But the early leaders, despite having billions of extra capital, despite being way more active with M&A, so organic growth would even be slower than presented here on the slide. Despite all the scale and distribution advantages, they have not grown. Meanwhile, look at the ideas that Ventum has presented as our top ideas in the Canadian cannabis sector. Initially, our first top idea began with Canadian retail. So on the top right of the slide, we have the sales and EBITDA of High Tide. High Tide was the first company I launched coverage on in the Canadian cannabis industry. I launched coverage when the quarterly revenue was about $13 million a quarter. In their most recent quarter, they crossed $140 million of quarterly revenue. So up 10-fold over that same time period. So they've outpaced the industry growth. On the bottom right-hand slide, more recently, in January 2024, we identified a group of select Canadian LPs that we believe were winners. Those Canadian LPs include two that are in the room tonight, Cannara and Rubicon. It also includes Auxly, MTLC, and Decibel Cannabis. If you take the sum total of those companies' sales and revenues, you'll notice that they go from 1.8 million, or de minimis, mostly pre-revenue in Q1 of 2019, to close to 100 million. So we have seen exceptional growth, again, far outpacing national retail sales growth from this group of companies. What's also notable about our call is we made this call at the cusp when in aggregate, some of these companies were profitable, but in aggregate, they were at break-even EBITDA. It's hard to see on this graph, but you'll see the EBITDA figures are the yellow in the lower bottom right. Since our call, this group of companies has turned solidly profitable. All of those companies are now profitable on an EBITDA basis, and those EBITDA margins are rising as these companies gain critical scale. And the growth hasn't slowed. If anything, the recent calendar Q1 results we've seen from these businesses have shown that growth is potentially accelerating. So how does this make for an attractive investment opportunity? Well, let's compare the basket of the companies we feel are winners against the basket of companies that many of us in the room might be more familiar with. The Canopies, the Auroras, the Tilrays, the Organigrams. The average 3-year CAGR of our basket of winners is up 41%. So that's a CAGR over the past 3 years. They trade an average EBITDA multiple of 6.8 times. Comparatively, the largest Canadian cannabis businesses have an average CAGR of 3.4% for their net cannabis sales. This is just their cannabis segment only to focus on what they're doing in what I believe is still their core business, even though many of them have other segments. And notably, of that 3.4% average, really only Organigram is considerably positive. They're above 20% on a 3-year CAGR. But Organigram has also been very acquisitive. So I think if you were to take this average, and if you were to back out the acquisitions, you would see a 3-year CAGR that's probably negative for the largest Canadian cannabis business, 4 largest Canadian cannabis businesses. They trade at an average EV/EBITDA multiple of 10.1 times. So the group of companies that we've identified as the better operators, they're growing more than 10 times quickly than the largest companies that we're all familiar with, but they trade at a 30% valuation discount. And that discount is quickly getting wider as companies report financial results. For example, Rubicon on the slide is presented at 7.2 times. Rubicon reported results this morning. That trailing 12 multiple is now 5.8 because their profitability is growing. So we believe that the valuation for the companies we've identified as the basket of winners is quite compelling, especially with the success that they're having in the market and with the valuations of the larger Canadian cannabis businesses. Now, I also said that this group of companies has several catalysts ahead. We're in Quebec today, so why not start with one of the biggest, in my view, catalyst opportunities for growth in Canada, which is the Quebec market. On the left-hand side, that graph shows the average number of residents per store. What you would see is that in many of the other Canadian provinces, such as Alberta, that number of residents per store is about 7,000 people per cannabis store. Here in Quebec, that number is 88,000. Or put another way, there are 10 times more stores per capita in other Canadian provinces than we have in Quebec. And yes, governments want to ensure cannabis is controlled, it's done in a safe and effective manner, but the legal market is the safest and most effective manner to do that, and we are leaving dollars in the hands of the illicit market when we don't have proper store coverage. So, the SQDC, they're continuing to add stores in Quebec. They're doing it at a gradual pace. That will be a tailwind for growth over the long term here in this province. and should continue to help cannabis sales grow across Canada. In addition, if you look at sales per capita in Quebec, and you compare that to other provinces, if Quebec were to have similar sales per capita as the lowest province, which is the Atlantic provinces, at $132 per person, or if they were to have sales per capita in line with the highest province, which is Alberta, at $194 per person, you could say that there is a $550 million to $1.1 billion demand gap just in Quebec alone. So that's enough to grow the legal cannabis market in Canada by 10 to 20%. I think store coverage is a factor. Another factor is allowable product formats. So we're very much looking forward to the launch of vape sales, which is taking place in Quebec, I believe, beginning November. I'm getting nods from the experts in the room, so that's good. So that category alone tends to be over 20% of sales in provinces and mature US markets where it is allowed, occasionally above 30% of sales. So allowing vape sales in Quebec, that alone could potentially add $200 million of sales to the total Canadian market. That's about a 5% lift. So we see some very clear catalyst opportunities, some that are coming this year and very quickly, others that will happen more gradually over time. But this is just a couple examples of some latent opportunities still available in Canada. Here's some other opportunities available in Canada. I've identified 3 regulatory catalysts that I think would help the industry. The first is excise tax rates. Excise tax rates, as initially proposed by the legislation, made it appear that regulators wanted an excise tax rate of about 10%. Maybe it might have been a little bit higher. Maybe they were expecting that to get into the teens. But as prices have fallen across Canada, that excise tax rate has also crept higher. We've looked at the excise tax rates paid by a number of businesses that focus on the Canadian adult use market. What we found is that they're paying an average excise tax rate of about 34% on their Canadian sales. So this is far higher than we believe was initially envisioned by the Cannabis Act that legalized cannabis in Canada. And this is potentially hindering the legal market's ability to compete against the illicit market. Now, this is a very difficult catalyst to make happen in real life. Finances are tight across the country. Provinces want their tax revenues. But if you ever hear anything about excise tax reform in Canadian cannabis, note that it could potentially add, if we were to go back to a 10% rate, an immediate 24% lift to sales. Or if the companies choose to pass on that price savings to the customer, then we're going to see the growth come through volume growth as we further eradicate the illicit market. But regardless, if those excise tax rates come down, there'll be a material lift to the legal operators. A couple other points on this slide I'll go through more quickly. Edibles and compliance costs. In edibles, we're limited to 10 milligrams per package. And in Canada, we're therefore seeing edibles only at 5 to 6% of sales. In other mature US markets that have edible limits as high as 100 milligrams, we typically see edibles accounting for up to 10% or even more than 10% of revenues. So I think this alone, again, here's another $250 to $350 million revenue opportunity that's being left on the table due to regulations here in Canada. The third is compliance costs. I provide one example on the slide. That example is the difficulty with excise taxes. Excise taxes are on a per province basis. A simple thing such as a national excise tax stamp would reduce inventory levels. You'd see fewer product write-offs in the Canadian market and would go a long way to easing the supply chain for these businesses. And the final slide that I'm going to speak to here today is the international catalyst that is opening up. On the graph on the left, that graph shows Canada's cannabis exports. That graph is only current based on Health Canada data to September of 2024. So we're missing a few critical 9 months in that data. But you can see that over a number of years, Canada's cannabis exports have been rising at a very robust pace. This is helping to absorb what was traditionally some of the excess supply in the Canadian market. It is also offering international growth opportunities to Canadian LPs that lead in terms of the quality of our genetics, our cost of production, and our branded and our brands and the R&D that went into that to make those resonate with consumers. On the graph to the right, instead of looking at the Canadian market, we focus in on a key international market. This is Germany. This graph shows the level of cannabis imports into the German market. This data was actually updated just on Monday this week, showed that German medical cannabis imports are up 4.5-fold year over year. German imports have been rising at a steady pace, but in April of 2024, the German government relaxed medical cannabis rules. And since then, we have seen a surge of imports into the German market. Not only are we seeing volumes growing like this, but most often when you see volumes like this and supply shortages, you're also getting a pricing tailwind as well. So we expect the revenue growth or the dollar value of imports into the German market are even higher than the 4.5-fold increase we've seen over the trailing 12-month period. One last point I want to make about international markets is regardless of whether you're targeting the international market or not, I think this is helping domestic businesses by taking away companies that were competing in Canada that are leaving store shelves in Canada to focus on international growth opportunities. And so even indirectly, companies that are focused only on the Canadian market, I think are benefiting as some of their weaker competitors that can't compete well here rush to international markets to save their bottom lines. So whether companies have a defined international strategy or not, this is absorbing excess supply in the domestic market, and it's helping all Canadian cannabis companies to succeed here at home. Questions good? Yeah. Great. Thank you very much.